Hey, good morning, everyone. Welcome to the Macro Snapshot. We're recording this on the morning of Tuesday, February the 24th, 2026. Okay, so we had a bit of a risk-off day yesterday, and possibly that was caused, there was some talk that there was a big research firm, Citrini, who basically released a very detailed report, which actually I was able to get a hold of and read a bit of it, which essentially said that, unemployment rate could go up to sort of 10% because there's going to be, according to them, massive AI related sort of redundancies causing a huge amount of unemployment, and therefore this very, very high unemployment rate and a recession all within sort of 18 months. So very sort of bearish. And so I don't know if that would cause it. A lot of people saying that that's what was causing a little bit of the sort of the equity weakness yesterday. I don't know about that, but it's definitely quite interesting. I want to look in a second just on what's happening in the bond market. There's some quite interesting sort of under the hood sort of things going on. But first of all, today we have ADP employment numbers at 8:30. So that's just the weekly ADP private payrolls. That'll give us a little bit more information, perhaps about the employment situation at the margin. We also have quite a few FOMC speakers. We have, about 4 or 5 speakers today. Yesterday we had Waller as well, who was a little bit sort of cautious. Waller was saying that, the recent strength in the January job numbers could be actually revised downwards. So if you put that together with the Citrini research sort of negativity, that was creating in the early morning session a little bit of a negative vibe. And of course, we had the news over the weekend that Trump's sort of global tariffs up to 15%. So what we saw, if we actually go and look at the just that sort of chart, let's have a quick look at that. If we go to the ES here, you can see here that as I was pointing out yesterday, that the bulls needed to get above the 61.8% fib retracement. You can see here that that was the key level at about 69.30-ish on the ES futures. And basically what happened is at the open, we sort of reached up there in the first 5 or 10 minutes of trading, and then that was rejected. So at this point, at least on the ES futures, that's kind of the line in the sand. The bulls will need to push beyond that and above that in order to reignite some kind of bullish narrative, and at least to maybe try and retest the highs. On the other hand, it was kind of capped more or less at recent lows, which coincides, approximately with the 200-day exponential moving average at about 68.45 or so. You can see here. So that's where we're trading this morning. Sort of relatively sort of choppy, not a huge amount of sort of energy. What is also interesting is just to again keep on looking at the relative performances of what's happening here. So if we look at the Nasdaq, you can see overall a much weaker market. That couldn't even get up to the 61.8% fib retracement or the recent high. So Nasdaq being led a little bit here by the ES and sort of still fairly low. And this one is below its 100-day EMA and above the 200. So Nasdaq definitely trading heavy. You can see here the Russell, on a relative basis, had a nasty day yesterday, but on a relative basis, in terms of the moving averages, you see it's above the, it held yesterday at the 20-day, the 50-day. So on a relative basis, doing well. Now, again, just the baskets I've been looking at, you look at the equal weight, again, had a bit of a nasty day yesterday, but again, on a relative basis, doing better. You can see the Mag 7s, pretty weak yesterday. And if you look at the chart for Microsoft, just really horrible. And that's again, it's part of this story that the semiconductors continue to well. You look at the indices or the indexes in Taiwan. You look at the Kospi in South Korea, which are very heavily weighted towards the semiconductors, still doing very well. And again, look at the semiconductor SMH here, or SOXX SOX. The ETFs also doing pretty well, but horrible by IGV, the software sector, which I've been saying has been sort of heavy, tried to have a little bit of a bounce. And this is just not good. Let's just put it that way. This looks like a quadruple bottom if such a thing exists. And when you get a quadruple bottom, the market probably wants to test, at least probe a little bit below just to run some stops and see what's going on here. So the point is here that that's looking very weak, and there's definitely a lot of dispersion. You can also see with the weak sentiment yesterday, if you look at some of the sectors, you can see, who was performing relatively well and not. But one thing I just want to sort of point out here is a minus 168 basis points was the overall technology sector, which was pretty bad. And this is very weak price action. You can see here, if we just put some kind of fib retracement on here, you can see that we did get a bit of a bounce, but it stalled out at the 68%. You go, okay. And then the problem here is that sometimes when you get that, you then have to do a reverse fib and say, well, okay, maybe the bulls will come in and pick it up at the 38 or the 50 or the 68% bounce, but that has not happened on the technology, the XLK, the technology sort of ETF. So at this point, this is trading heavy. You see the moving averages, the shorter term 20-day here starting to sort of cross over the 100-day, 50-day pointing downwards. So this price action is heavy and not looking great. What is interesting is that just in the consumer space, if you look at the difference here between the discretionary, again, very, very heavy price action. Look at these moving averages pointing downwards. The same situation as the technology space, that we had a failed bounce. And then the bulls didn't really pick it up, and now trading, below the 200-day EMA. So this is very weak, down 2% yesterday. But compare this consumer discretionary to the XLP, which of course is the consumer staples. Now that had a couple of sort of consolidation days, but again, ripping higher yesterday, a complete outperformance there from consumer staples, defensive compared to the consumer discretionary. So the point is here, a bit of a risk-off day. And I just want to look at the bond markets here. I mean, and we'll get today as well, just talking about this kind of stuff. We'll get Home Depot earnings today. And that's going to be interesting just to see, in terms of, is the consumer sort of feeling good? The spending still seems to be okay. So it's almost like a sentiment thing. We also get consumer confidence readings today. So, there's still is still relatively robust consumer spending. But is that because people are starting to dip into their credit cards? I was reading some research this morning from Bob Elliott, basically on this theme of dis-saving. So essentially people are starting to save less. The savings rate is going down. So it almost seems that people are still spending, but they're sort of putting it a little bit more on the credit cards, and they're starting to use their savings more or savings less to actually have the same level of sort of same kind of lifestyle. So there's going to be an interesting theme of, things are sort of perhaps weakening, but people are still in a relative situation here. So really the question is going to be, is the market going to, or the general economy going to start weakening? Who knows, in 6, 12, 18 months? And this is the theme of Citrini research, essentially saying, guys, AI is coming. It's going to start taking and wiping away jobs. And certainly if you look at companies like, let's look at a few things just to very quickly. If you look at, let's say, Microsoft, we all know this chart, but just look at this chart. This is a horrible chart. I mean, this is a premier sort of company, but something like Microsoft being absolutely destroyed here. And we also saw the IGV sort of technology thing. And if you look at Salesforce, let's just have a look at that. So what's the ticker again? Salesforce CRM. If you also look at that, pretty horrible. And the point I'm looking at Salesforce and Microsoft, not only them, but just companies which are very, very heavily sort of focused on the software sort of sector. And they're the companies which, and logistics company, these companies which really are purely just providing sort of, software as a service in itself. The idea here is there was another update from Anthropic yesterday, and just all of these companies being really hit by this narrative. I don't know if it's the reality that, their specialized services are essentially going to be sort of cannibalized by the sort of increasing sophistication of the AI players. So we're definitely getting this sort of loser and winner kind of mentality. Okay, and again, I just want to talk about the bond market here. And what's kind of interesting, and just bear with me for those of you who don't love bonds here, because I think it's giving us a few different signals here. If we actually just look at the bonds, I want to look at some of these. Where are my yield curves here? Yield curve, UST. So it's kind of interesting to see what's happening. So if you look at the 2s to the 5s here, a huge flattener. So what is that saying here? That's saying that the yields on the 5-year bonds, so sort of, and keep in mind that symbolically the 2-year is more really, what is the Fed doing? The 30-year is more about sort of issuance and inflation and growth and whatnot. And a little bit of geopolitical risk. And the 5-year is often used by the market as a kind of a proxy for sort of like, hey, what's happening in the midterm of the US economy? Not necessarily strictly, 5 years, but when you're looking at the spreads, you've got to keep it, that's the sort of the symbolic sort of optic through which the bond market looks at these spreads. And look at this very, very dramatic, very strong sort of flattening here on the 2s, 5s. So that's basically saying that the yields on the 5-year curves are coming down, is on the 5-year yield is coming down a lot more than the front end. So the front end is a little bit anchored and essentially saying, hey, the Fed is maybe not cutting that much in the very short term, but the prognosis for 5 years is sort of a weaker, sort of potentially a weaker economy. And you see that 2 to 5 years of sort of flattening there. And then if you look at the twos to the tens, you can also see a flattening as well. So that's sort of 5, 7 a year sort of a tenor is the one being supported. Then if you look at the fives to tens, you go, oh, is that happening as well? But then you can see actually, if anything, a slight sort of steepening. So you see it's pivoting around the 5, 7 year sort of point here. And that's sort of saying, oh, maybe there's a little bit of concern with the 10 year. Now, if we look at the twos, 30s, you can see that that's relatively flat. A little, it has been flattening, but not nearly as much. And then if you look at the fives, 30s, you can see it's actually steepening. So you see the 30-year yield is up more than the 5 year. And then finally, if we look at the 10s, 30s, you can see that that's actually been steepening as well. So what are we trying to say here? And I just want to look again, just want to go back and show you something here on the butterfly, which is basically taking the three different spreads, and we're looking at them. And if we look here at let's have a look here. What do I have here? Yeah. So this is the twos. No, this is going long the 5 year yield, and then shorting on the wings, the 2 years and the 30 year. And you can see here, you see how that's really going down. So that's basically saying that the 5 year yield is going down. You see here a lot more compared not only to the 2, but also the 30. So we're seeing weakness or relative weakness on the 2 year and the 30 year, and the 5 year is really being bought. So the market is buying the 5 and the 7 year bonds, outperforming the 2s and the 30s. And again, the 2 year is sort of saying, well, hey, the Fed's not really necessarily cutting that much in the short term. And then if we go out to the 20 and the 30 year, it's essentially indicating stress potentially about sticky inflation, too much issuance, the deficit. We saw between the 10s and the 30s, the term premium is going up. So what I'm trying to say here is that the bond market seems to be giving us a little bit of a signal. And I also want to show you what's going on with, let's say, the SOFR market. So the SOFR market is every 3 months. Short-term sort of contracts. And just interesting looking at the spread here. So this as a sort of a dotted line, what they're calling the benchmark here, is essentially from the beginning of the year. And you see that curve there, and you see that the terminal rate was about 3.1. So the first thing I want you to notice is, this was snapped just on a couple of days ago, is the heavy blue line here. And you can see how the curve is shifting. Now, what is this telling us? We're seeing that at the front end. So this is basically the next 2 or 3 contracts. So the next sort of 6, 9 months, you can see that the implied yield here is actually pushing higher. That's hawkish. That is the market essentially saying, hey, in the short term, the economy is okay. People are still spending. The Fed doesn't need to cut as much. Okay, so you see that that's actually repriced in the last sort of 6 weeks hawkishly. But what you can actually see here is that the terminal rate, which is the lowest part, that's actually gone down a little bit from about 3.1. Now you can say, oh, it's not that much, but it's actually gone down. So that's indicating a slightly deeper cutting cycle. And you can also see here that overall, what the market is essentially saying is more hawkishness in the short term. But as soon as we start going out, you see here into June 27, September 27, and December 27, you can see deeper cuts. So it seems to be that what the bond market and the SOFR, the short-term interest rate market is telling us is the following. And again, I just want to look at some of the SOFR moves here, just to give you a sense that this is quite real. If we just go out and just again, bear with me here for a second. If we look at some of these SOFR moves here, so let's say, for example, we're looking at September 2026, the price action here, going down a little bit. But if you start to look at December 26, you can see it's starting to move up. And then if you look at something like December 27, you can see, look how much that's moved. And if we look at some of the spreads here, I just want to show you a couple of things here. So let's say, for example, we look at June 26 to December 26, you can see here that the later ones are starting to really perform. This is more dovish. This is saying the longer term ones. And then if we really look out a little bit, I mean, look at something like this, like December 26 to December 27. You see, so this is the spread between December 26 and December 27. And you can see this massive dovish repricing. And essentially, this is essentially saying that the cuts are going to come deeper but a bit further out. And that's also what we're starting to see in the regular sort of bonds as well, essentially saying, hey, in the short term, the economy is okay, but the market is really starting to price in longer term weakness. At least that's what the bond market is telling us. So let's just keep that in mind. And maybe, as I say, that's a function of what we saw from the Citrini research report yesterday, essentially saying that there's going to be a huge wave of AI caused redundancies and a big spike in unemployment and therefore a recession happening sometime in the future, maybe 18 months, 2 years, 3 years, something like that. So just keep an eye on these sort of SOFR curves and the general sort of curves as well, because definitely the bond market is moving quite a lot. Now, I'm gonna have a sip of tea. Just quickly on a couple of other things. So we have the State of the Union address at 9 p.m. today. Trump, unfortunately, has promised us a long speech. He's told us he's going to tell us how wonderful the U.S. economy is. So I think there's going to be a lot of sort of self-adulation, self-flattery, narcissistic chest thumping. So that's going to be a bit tedious. On the other hand, I guess we need to sort of check out whether there's going to be more information about the tariffs and also just sort of other trade policies. Who knows, maybe something about Iran as well. I'm a little concerned. I mean, he has a sense for theatrical. Is he going to sort of say something that, as I'm speaking, American missiles are hitting Iranian targets? Let's see what happens. I hope that's not the case, as my daughter is in Qatar as we speak. So let's hope that doesn't happen, at least in the next 24 hours or so. But let's keep an eye on the State of the Union address, as I say, 9 p.m. That could cause a little bit here. Just quickly, a couple of other things I'm looking at today. Let's look at the yen, because there was quite a lot of chatter out overnight. You see here that the US dollar is strengthening against the yen. The idea here is that the Japanese Prime Minister Takaichi actually met with the governor of the Bank of Japan, Ueda, and sort of wagged her finger and said, hey, not too excited about you sort of hiking rates necessarily. Keep in mind that she very much wants to be stimulating the economy. And I suppose, again, and no one is privy to those conversations, but the sort of the leaks in the Japanese press is saying that she essentially said to him, hey, where possible, let's not have too aggressive hikes. So obviously the yen weakening on that, the Japanese, the US dollar sort of strengthening. So that's positive for the US dollar there. We can see overall the US dollar not really loving this tariff uncertainty and kind of crawling its way back up. But as I've been signaling for a long time here, this 68% fib retrace level, which is just above the 50-day EMA, essentially at 98, that's really the one. So if the bulls can't push it higher here, and that's going to face some quite serious resistance there. So that's definitely a pretty key level to be looking at. But just also looking at that Japanese, the weakness in the Japanese yen, what we can see is that if we look at something like the Nikkei having a bit of positivity, because the Nikkei in general does like a weak yen, which is good for the Japanese exporters. So this almost looks like a sort of a flagging, a bull flag kind of situation here. So looking for the Nikkei potentially to push higher, at least maybe to retest the local highs here. And just while we're on some global equities, you can see Brazil still doing pretty well. If we just look over in Korea, as I mentioned earlier, Kospi makes a new high, all-time high. So just going absolutely crazy over there. And again, this is on the sort of the semiconductors strength and exporters, and the memory chips doing very, very, very well here. Just other stuff to have a look at. As I say, keeping an eye on oil. Oil is trading still within a range. You can see here, let's just zoom out a little bit here. You can see that it's failed to make this sort of high at 68.60. So really oil is stuck in this sort of trading range here, so to speak, more or less capped out at about $67, and the mini range here is about 60, 65.30. As you can see, the broader range is a bit more down there. So I think oil's just really trying to sort of see what's going on in Iran. Does do the talks continue? Does Trump attack? We will see what's happening here. So oil just trading within that range. Gold, well, the crypto space here, pretty nasty overall. If we look at BTC, there was talk about one of the original OG gods sort of liquidating some holdings overnight. But crypto, I mean, I was looking yesterday at the Ethereum, the Solana, all of this stuff, trading, strategy, all trading sort of horribly in terms of just the price action here. I mean, it's so horrible. It's almost tempting to sort of have a stink bid to pick up some, just because the narrative and the sentiment is horrible. But just from a purely technical perspective, which is where I like to look at look at this, you can see here as I've signaled here, down here is looking like a sort of a tempting target. I mean, the next target on the BTC is obviously about 60,000. This, obviously we get a bit of congestion there, a little bit of sort of previous trading action going back to the glorious summer of 24. But if that 63, if that 60 level can't hold, you've got to think that maybe down to 53 is what the technical chart is telling us. The point is here, the moving averages are all looking down. There's been no bounce, and any bounce has been modest and promptly sort of whacked. So the crypto space not looking good. Copper just sort of doing anything horrible at this point, just sort of consolidation. Keep in mind the Chinese market participants are back. What we did see yesterday was a pretty strong price action from gold breaking out, just having a little bit of resistance here. This topside resistance looks a bit weird on the daily chart, but that's actually a sort of an intermediate level. If you go on the 30-minute chart, that's actually like a little bit of a sort of intraday 30-minute level there. And that's why I think we had a little bit of a pause. So this is going to be interesting to see here. So we're above the 61.8 fib retracement here. So that's pretty nice price action for the bulls. As you can see here, the Fibonacci extension measures a little bit higher at, sort of comfortably in the sort of the recent highs up at about, $5,500. Just taking a little bit of a pause here. Let's just see if the bulls pick this up. What they'll have to do, let's put it on just a clean fib here, just to keep it clean sort of visually. So as you can see here, really no technical damage at this point. The bulls will have to start picking this up. The 38% comes in about 5,075. And then you can see these various levels here. So anything in this zone here is okay if the bulls want to pick it up. You don't want to see this sort of drifting too much lower than, let's say, 4,900. But if the bulls come in here, definitely the door is open for a further upside move. Similar kind of situation in silver. Again, constructive price action is getting those short-term moving averages starting to turn higher here. So the bulls are doing what they need to do. Again, you can see that sell-off seems to have already been sort of bought on the dip. So at this point, we're trying to get it up to the recent high at 92,150, and then you have the 50-day 50% fib retracement, and then of course the 61.8. So the precious metals looking quite good. Industrial metals probably just want to see what's going on in China at this point. One thing I will say just to finish, I was just reading an article yesterday that China has pulled back massively from its investments in Africa. And you say, okay, Angus, why are you mentioning that? And what I'm trying to say here is that that was really part of their geopolitical push, their strategic push for sort of influence over sort of raw materials and rare earths and all this kind of stuff in China, sort of in Africa. So the fact that they're really, really pulling back their investment just leads me to think that the Chinese maybe at the margins are sort of starting to tighten their belts. The real estate situation there is horrible. And I just wonder about the Chinese economy. So let's just keep on reading stuff about that. So if you see China pulling back from global investment, to me, that's a little sign, sort of canary in the coal mine, in the coal mine, that maybe the Chinese economy actually is under sort of a weakness, at least at the margin. So that's interesting. And the reason I thought about that, I was just thinking about sort of industrial metals and whatnot. Okay, I'm gonna leave it there, guys. Let's keep on looking and see if the equity has a bit of a bounce today. And as I say, probably pretty important to be looking at what's going on in the software sector, the mags, the big ones, and then of course we have Nvidia tomorrow, which could maybe be the next direction for the equities. That's enough for this morning. I'll be back tomorrow with the snapshot from the macro shop. Take care and have a great trading day. Thank you.